Peak Wealth Management proudly presents Finding True Wealth with certified financial planner Nick Hopwood and accredited investment fiduciary Jim Pilat. Nick and Jim believe by making simple, good financial decisions, you can retire with confidence. And now, let's turn it over to your hosts, Nick and Jim.
Welcome everyone to episode 171 of the Trust the Plan podcast. I am Nick Hopwood.
And I am Jim Pilat.
And today we're talking about being a fiduciary. What does that mean?
Yeah, we talk about it a lot. Fiduciary means you have a legal responsibility to do what's in the best interest of your client.
So when you make a recommendation, you're recommending what you think is best for them.
Right.
Not any other consideration, such as commissions.
Right. No, yeah, your decision has nothing to do with, from our seat, right, how you're compensated or any advantage you may receive from that recommendation. It's just simply in the best interest of that client.
So let's say we sell windows, okay?
Mm-hmm.
I can recommend Andersen or Pulte, right? Mm-hmm. Let's just say they're the same price and they're both the same quality. Mm-hmm. I think they might be, I don't know. One might be better, I don't know.
Yeah.
But if Pulte is paying a double commission, Pulte's the, I'm sorry.
I was going to say Pulte's
the house. What's the other window manufacturer that's, okay, never mind. So company ABC and company XYZ.
Yeah, there you go.
So if XYZ is going to pay us a double commission,
right,
and all else is equal, well, what are you going to do?
Right.
You're going to recommend the double commission one.
Right, or maybe, if you sell 20 of the, company X windows, you get a trip to Cancun.
With the Joneses.
Right?
Yes.
So
that's how they get there.
Yeah.
Okay, so the trip incentive, right?
Right.
Or an extra commission. But if both windows are the same, then it truly doesn't matter, right? Mm-hmm. But what if the one with the incentives is not quite as good, right? Mm-hmm. The track record isn't as good, the warranty's not as good, the service is worse. Right. Then we have a real problem.
Right.
Right? This is like a breach of the fiduciary window standard.
Yes, it is.
Okay. So when it comes to financial services, this type of stuff is way more complicated than windows because there's a myriad of different products and different ways to charge and hidden fees, right?
Right.
So it's way more complicated. And so let's talk for a second about commission products versus fees, right? Mm-hmm. So we actually are an RIA, Registered Investment Advisor, where we manage portfolios for clients for a fee. Mm-hmm. And our financial planning and our investment management is all part of that one fee.
Right.
Whether we recommend strategist A, B, or C, or a Roth or an IRA or a brokerage account, whatever the case is, it's always the same. Right?
It is, yep, absolutely.
Okay. So we have no incentive to do this or that.
Right. Yeah, whatever strategies we recommend, whatever money manager we think we should use, whatever account we should open, it's all the same to us, right? We're just put ourselves in a position to say we think this is the best for the client.
Yeah.
We make the same no matter what they do. So
exactly.
That's how we uphold that fiduciary duty.
But we also still hold our old FINRA licenses like Series 7, Series 63, this old stuff, okay? Mm-hmm. And we hold that because if someone comes to us and they have an annuity or something different, we can still be the agent and still service this, okay? But people are still buying lots of annuities, okay? The volume has not dropped, right? And so we could, in theory, recommend an annuity versus a fee-based platform. The annuity has a commission, okay? And now we have really muddied the waters of the fiduciary standard, right? Because an annuity could pay us a one-time commission or a larger upfront commission, which some people might be incentivized to recommend versus over here. But the annuity could make the client committed for X number of years with way higher internal costs, some which you don't even know that they're there.
Yeah.
Right, so you could be paying like 1% versus like 3%. Okay, which is a huge consideration with costs.
Yeah, and that's not an exaggeration either. I mean, we see those actual numbers play out all the time.
So a lot of times we see people purchasing an annuity where it's justified because of the income guarantee, which can be powerful. And when rates have been in the 0% range, just anchored at 0 for so many years, getting a 5% guarantee could sound appealing.
Yeah, definitely. People want that predictability, and that's, one way to do it.
And with a lot of people not having a pension, right? You could see, well, my Social Security doesn't quite cover all my fixed expenses. It would be nice if I had another guarantee in place. So you could make the case to take some of your portfolio and generate some income, but you wouldn't want to do all of it, would you? You wouldn't want to lose. Go ahead.
No, you're absolutely right. Doing all of it. I mean, that's the thing. You have to think there's always trade-offs, right? If you want that security of an income stream or an income guarantee, the trade-off is that money essentially becomes illiquid, right? It becomes really difficult or prohibitive to actually take that money out and use it for something else. Maybe you don't want $1,000 a month anymore. You want $50,000 to go do something with. Well, you just made that really difficult because there's going to be penalties and fees to exit that investment. You're going to wreck your income guarantee. Like the liquidity is a major consideration.
Yeah, absolutely. So we found an article talking about the fiduciary standard and an advisor recommending that the clients put a significant portion of the portfolio in an annuity, which they are pitching it as low risk. So the thing is, there's many different types of annuities out there too. There's the immediate annuity, like think of it like a pension. There's a fixed annuity, think of it like a CD. There's a variable annuity, think of it like mutual funds. Then you can add guarantees to the variable annuity. So, if the market goes down, you still have a guaranteed income. So there's all sorts of different flavors. This is not a recommendation for anybody, just some educational wrapping going back and forth here. But is it a breach of the fiduciary standard if I make that recommendation?
Yeah, I mean, it's definitely something that needs to be looked at, right? If you go
just a yes or no.
I mean, it needs to be scrutinized, right? And you need to understand, why is the recommendation being made? Why, are we recommending something that is now likely to be more expensive with less liquidity and more restriction attached to it, right? So I want to just say maybe, right? Maybe is it a breach of fiduciary responsibility? It could be, but it could also not be.
Right. Yeah. It depends on the needs of the client. So if they are risk averse or they really are attracted to this type of a guarantee, then you could break off some of it and assign a guarantee to that money.
Right.
But the thing is, right now, right, interest rates are up, and we can make 5% on fixed income. And so these annuities typically have a 5% income guarantee. So why are we spending 3% to get 5% if we can just go get 5% without
it,
all these costs, right?
Yeah, and I've mentioned this before to other people, like, there's things about annuities that people find attractive, right? The safety, the security, I can't lose, all these different things, but products have evolved, and pretty much, I can't think of anything that you can't do outside of an annuity that you could only do through an annuity. You know what I mean? If you want downside protection, we can do it with tons of flexibility. You're not tied to it for 10 years or more. And we've seen people tied to annuities for 10 to 15 years, right? With penalties associated to it. We can you can find buffered notes and things where, we can still get that same kind of downside protection, but it only lasts a year. Or if we don't want to even hold it a year, we could sell it tomorrow if we wanted,
So you're referring to the structured note type product, but also ETFs have those. Some ETFs have those types of.
They trade like outcomes. An ETF, yeah, definitely.
So that would be like the buffered annuity, and then the income annuity, which has been popular over the last 15 years with rates at 0. If you can go get your own 5% rates, we already talked about that. And CDs are offering probably, I haven't compared fixed annuities versus CDs, but if the rate was the same, I'd rather have a CD because the FDIC, and it can be in a brokerage account rather than having to go direct to the insurance company. Although the fixed annuity offers tax deferral if it's outside an IRA. So that's something to consider. But ultimately, before you put half your money into one of these products, it's time for a second opinion.
Yeah,
Right?
That's
Let's
good.
look at your comprehensive financial plan and say, well, if we make 5% on your money, is your plan going to work? And can we find a way to make 5% and still have low risk or moderate risk?
Right.
And the answer may be yes, with way less cost.
Yeah, especially now. And that's, the timing of this article, it just came out recently. So, is that particular advisor in the article breaching the fiduciary duty? I don't know. With some of the options, like you said, with rates
more
being
information.
high and things, I mean, it's possible that it's a commission grab.
It's possible, but we need more information.
Yeah.
Okay? Now, let me also say this. What if, some broker-dealers are actually part of insurance companies, okay? So what if you grow up or you're trained in that world,
Right.
where the annuity is the recommendation for everyone? They're certainly not operating in a fiduciary standard
Right.
with that type of setup, but they don't think they're doing anything wrong because that's the way they were trained.
Right. That's what they were taught. Yeah.
So we have this unique independent perspective where we've seen both. Okay, now we tend to come to the registered investment advisor side more often than not. I should say 99% of the time.
Yeah,
right?
definitely.
But we still see both worlds, right?
Yeah, absolutely. And so the answer to the question, right? Just because somebody earns a commission doesn't mean they're breaching their fiduciary duty, but it warrants a couple additional questions being asked and really fully understanding the what and why of the recommendation.
Okay, and so one last point: when the advisor sells the annuity, they get to choose the commission schedule. There's a certain amount of money that goes to the commission, but they can choose how they're going to collect it, right? And they might not make any extra. They might just make like a trailing commission, which is the same they would have earned if it was managed money, and that's fine, right? But the tell, here's how you know if the breach was made, right, is if they chose the upfront commission, right? They just want to get that payday and be gone.
Yeah, and that is where we see a lot of problems.
Makes me so mad.
People who have annuities, the person who sold it takes the upfront commission, and now they've lost all incentive to continue to service that person, to continue that relationship with that person because they already made all the money.
Yeah, so what happens? They get bad service, they get mad, they leave, they come to someone like us, and then we're like, oh, well, we can be the agent on the annuity, and then we go through all the work to become the agent, and now we are officially servicing it, and there's no compensation, zero compensation.
Right.
So we're just doing
we
it.
Take on the risk though of being the agent on it, but you see it too often, but
yeah. So if you are in need of a fiduciary, we can be in your corner. We can offer a second opinion. You can schedule online at peakwm.com, and make sure you subscribe and hit the bell and like and whatever you got to do. It'll help us out. Thank you.
You've been listening to certified financial planner Nick Hopwood and accredited investment fiduciary Jim Pilat on the Finding True Wealth podcast, sponsored by Peak Wealth Management. You can learn more about Peak Wealth Management by visiting peakwm.com or follow on Twitter at nhopwood1.